by cutting rates next week. Bad data translated into equity positive. So we saw very strong gains coming through. In fact, the biggest daily gain that we saw in about 7 months. It looks like we could see quite a bit of a tepid session, pretty much flatlining at the get-go. But remember, earnings will continue to dictate. A lot of numbers coming from the banks and some of the blue chip companies as well. Let's also get some thoughts from David Costa. He is Dean at Robert Kennedy College, joins us live from Zurich as well. And our guest host, Rob Aspen, is with us. David, good morning to you. Nice to see you this morning. So, David, we're talking about this. Bad data translates into something positive for equity investors. So if EFO disappoints, is that going to prove another leg up for European equities?
Well, I think there is a bit of a disconnect between what the results are going to be in terms of the economy and what is going to be for investors, for equities. And that I would expect to continue because we don't have this much of a correlation. We have a weak economy. We're going to continue to have this weakness in Europe throughout unless we reverse this too much austerity, which will only produce no growth environment and at the same time what is going to be a bigger threat, which is higher unemployment. But on the equity side, the valuation is still reasonable, particularly if you compare to the S&P 500. So I would say here we still have, particularly if we continue to have positive political news like from Italy, we continue to have a bigger rally, and also the big expectation of the rate cut next week will propel again equities higher in Europe.
Yeah, so as long as this rate cut speculation keeps up, how are you viewing the banks? We just had numbers coming up from Credit Suisse, return on equity 14%, and their overall numbers look much better than expected.
I think Swiss banks is going to be a bit of an exception. We still have a lot of competitors. I think two of the major Swiss banks have really done a lot of changes which will now start to pay off. And that still is potentially a good investment. The valuation are fairly moderate still here. But again, I would say the Swiss market as being an exception. In Europe, we're still going to have some interesting valuation in terms of banks. There's going to be a recovery, but at the same time, Switzerland, I think, is a bit of a privileged place. So certainly Swiss banks are more interested than European banks as a whole because there is much more picking which has to be done in Europe than you have to do in Switzerland, when we don't have many of the problems which we see throughout the banking sector in Europe, including the high fragmentation.
Yeah, David, from our side, this is Rob at SCB. We would actually favor, for example, the healthcare sector and industrials relative to the financials, which we are more neutral on. We're not particularly positive on the financials. And the concern that we have with the financials is really the tail risk. If you look at the bond market across the periphery, for example, yields have come down significantly. But I think both of us would agree here that there is significant tail risk as well within the banking sector. Would you agree with that?
I would agree, and I would say that in many European banks, we don't have yet the level of clarity and transparency which I would need to make a much more stronger recommendation. While in Switzerland, the market is really different. We have a much more global exposure, and that's also going to pay off. But in terms of European banking, there is a tail risk still there, and we still have a lot of opacity in many of the peripheral banks.
Yeah, and also you're saying gold is going to rise while Goldman is telling their clients to get out of gold?
Well, I think gold is definitely going to rise. The question is pretty much when. What happened in the last days is really pretty much a higher volatility caused by paper gold. But in terms of physical gold, the sales of bullion coins, etc., is still going up. Investors are seeing this, rightly so, as an entry point. So sooner or later, we're going to have a problem with inflation, a problem with this money printing, and more intervention even, particularly in Europe, which I think sooner or later will come. And gold as a currency and as a part of the portfolio, non-speculative, not on a matter of days or so, but on the long term, having a percentage of the portfolio in gold is still, for now, I think, a good option and a good buying opportunity now. So eventually, it will rise again because of all this money printing which is going on, and will have to continue given the weakness on the overall economy.
David, I hear your view in terms of the longer-term outlook for gold being positive, but what about on the short term, given the technicals? Do you anticipate that it could fall significantly further? And if so, what sort of support levels would you look for?
Well, it's difficult to give some numbers here, but I would be surprised to see a similar drop to what we had in the past. And if that happened, I would say it will pretty much be driven by this paper gold, the fact that we have so many ETFs, high frequency trading, and the possibility to increase the volatility. So of course there is still a downside risk. So perhaps an investor which is starting now in gold, I wouldn't accumulate everything right now, but I would be very surprised to see another drop as big as what it is now. And if we have it, I would see that investors, including central banks, will step in as a buyer of physical gold against the paper gold speculation, which very often is much more leveraged. So on the physical gold, I wouldn't see a huge sales going on. And much of the recent one was also caused by the rumors of the Central Bank of Cyprus that would have sold the gold, which apparently is not true. So I think that is not going to be the case on physical gold.
Yeah, Cyprus certainly creating a lot of ripple effects in the gold space. David, good to see you this morning. You have a nice one over there over in Zurich. David Costa, Robert Kennedy College, and Rob Aspen of Standard Chartered Bank Wealth Management Group. Thank you to you both gentlemen there. And let's get a quick checkup on how the great